I thought of ownership structures as being dominated by one large shareholder, say Bill Gates at Microsoft, or Tim Cook, or before Steve Jobs at Apple. And therefore, sure, you have diversified shareholders like the big mutual funds that own both Microsoft and Apple, but clearly they would have nothing to say because the CEOs or founders would be the largest shareholders of these firms. Now, it turns out I was wrong. Empirically speaking, looking up the largest shareholders of Microsoft and Apple, it turns out are both two large mutual fund companies, such as Vanguard and BlackRock. And typically, the CEOs of firms own a very small fraction of the stakes in their firms. So clearly, just the premise by which I thought or evaluated these theoretical insights was just wrong. And it was the empirical collaboration with Jose and Isabel Tecu, who was a colleague of Jose's at the time, that really only convinced me that there's an actual issue.
And so what are the consequences of shared ownership?
Whether you have a firm like my imagined Microsoft with one large blockholder who has a concentrated interest in this one single firm, perhaps elsewhere those would be activist investors that only have an interest in one particular firm in an industry. These firms operate very differently and behave very differently in strategic interactions, such as in competition, than when these owners are absent and the largest shareholders are just big diversified funds that do not have such a concentrated interest in one firm. So my big takeaway is just firm behavior depends on the ownership structure.
Okay. We teach that diversification is a good thing, so this is probably good for the investors, but might there be a negative side of it in terms of reduced efficiency on the production side, so to speak?
That's right. As I said, the main finding of the first papers is that product prices are higher. So that's true in US airline ticket prices. It's true in deposit markets in US banks. And higher prices and lower quantities produced, that tends to come with an efficiency loss for the economy. Now, this is not necessarily a bad thing for shareholders. Monopolies typically are not bad for shareholders. That's why monopolies exist. But it's a bad thing for, exactly, but it creates a welfare problem because just the total output is being reduced. And there's a so-called deadweight loss in the economy. Consumers suffer particularly.
Is it a case for regulation? Should something be done about this?
So it's definitely a case that regulators should think about very carefully. As you said, diversification is a good thing. Diversification, retail investors like me and you benefit from that as well. And it's very basic finance theory that tells you that diversification is a good thing, that we should not take away from investors. At the same time, product market competition is a great thing too, which we want to preserve as well. So there's a certain trade-off between these competing goals that we have when designing economic systems, and we're really just at the beginning of thinking about what the optimal trade-off between the various goals is.
Okay. You have primarily looked at US data.
That's right.
Most of the conclusions, empirical conclusions, are built on US data.
That's right.
You've also looked at some European countries. Is it your impression that Europe is different from the US in these respects, or is it basically the same story?
So it is true that among the publicly traded firms in European countries, there's a substantial degree of common ownership by the same investors, even by the same mutual fund families partly. But it is also true that a smaller fraction of the general economic activity happens in publicly traded firms in continental Europe versus the US and the UK. Now, that doesn't mean that there's necessarily a smaller problem. If I, as a private individual, start a private equity fund that buys multiple firms in the same industry, that will not show up in the same way as we can see in the data in the US. But of course, it would create exactly the same incentive problems that we talk about using data of publicly traded companies. So the short answer is somebody would have to take a stab and look at industries within continental Europe to answer your question, and nobody's done it so far.
Okay. maybe that's a challenge for the years to come.
I think so.
Thank you very much for coming here.
Thank you very much, Per, for organizing. Thank you.